I want to start with something that sounds almost cruel, because nobody on the financial channels will say it to you plainly. When a real opportunity opens in a market like silver, it does not arrive wrapped in good news. It arrives disguised as a mistake. It shows up looking like the exact moment you were wrong. And the people who profit from your fear, the big trading desks and the commentators who echo them, count on you never being able to tell the difference. So if you are holding silver right now, or if you have been circling it, thinking about it, waiting for a sign, I need you to hear this clearly. The thing that is happening in silver at this moment is not the ending you have been warned about. It has every feeling of an ending. It has the ache and the doubt of an ending. But being right too early and being simply wrong feel exactly the same while you are living through them. And that confusion is the whole game. By the time I am done, you will understand why the discomfort you feel is not a warning to run, but the price of admission almost nobody is willing to pay. Here is the first hard truth, and it is one you can hold on to no matter what the screen says on any given morning. Through this entire pullback, gold has barely flinched. Silver did the falling, the heavy, stomach-turning swinging, while gold sat there almost still. And when silver drops while gold holds its ground, something specific has happened that most people miss entirely. Silver did not just get cheaper. It got cheaper relative to gold. The discount widened. The metal became more out of favor, more unloved, more discarded, at the exact moment its story got no worse. That gap between the two is not noise. That gap is the opportunity the title of this video is pointing at. Now let me take you somewhere, because the feeling you are having has a history, and understanding that history is the difference between a shaky holder and a steady one. Go back to the middle of the 1970s. This was supposed to be the great decade for hard money. Inflation was tearing through American households. The dollar had been cut loose from gold at the start of the decade, when the gold window was closed and a president promised it was only temporary. Everything that was supposed to send precious metals soaring was in place and in motion and undeniable. And in the middle of all of it, gold collapsed. Not a little dip. From its highs in the mid-70s, gold lost close to half its value. It nearly cut in two. Picture the person who had understood the whole thesis correctly. He had read the situation right. Inflation was real. The dollar was being debased. The case for gold was sound. He bought. And then he watched his conviction lose nearly half its worth, while the very inflation he predicted raged on around him. Imagine sitting at your kitchen table in that stretch, holding the thing you were right about, and feeling every single day like a fool. Here is what that man could not know, because nobody can know it from inside the drawdown. He was not wrong. He was early. And early, while it is happening, is indistinguishable from wrong. Because from that terrifying bottom, gold did not just recover. It multiplied roughly 8 times over into the peak at the start of 1980. The full journey, from where it began when the gold window closed to where it ended at that peak, was something on the order of a 20-fold move across the decade. And the people who got shaken out in the middle, the ones who could no longer stand feeling like a fool, they sold their correct thesis at the worst possible moment and watched the rest happen without them. That is the pattern I need you to carry through the rest of this video, because it is the spine of everything. The deepest, most violent shakeout came not at the end of the story, but in the middle of it. The gut check was the toll booth on the road to the real move. And the emotion that pushed people out was not stupidity. It was the perfectly reasonable, perfectly human inability to tell early from wrong. Now, why does this happen? Why do these metals put you through a trial by fire right in the middle of being right? Part of the answer is mechanical, and it is the part the big desks would rather you never think about. The paper price of silver, the number that flashes and swings, is set in markets where claims on metal vastly outnumber the metal itself. That means the short-term price is far more about leverage, positioning, and margin than it is about how much actual silver exists in the world. When enough leveraged players get squeezed, or when the rules on how much you must post to hold a position get tightened, the price can drop hard and fast, even though nothing real about silver has changed at all. We have watched this happen in plain sight. There was an episode where the margin requirements on silver were raised sharply, and the price fell around 30% in a matter of days. Nothing fundamental about silver shifted in those days. Not the supply, not the demand, not the deficits, not the industrial reality. Only the cost of holding a paper position changed, and that alone was enough to trigger a cascade of selling that felt to every holder living through it like the fundamental collapse of the entire thesis. It was not. It was plumbing. But plumbing that hits your account looks exactly like doom. And this is precisely where I have to stop and talk to you directly, because we are at the point in this story where the fear is heaviest, and the fear is exactly what someone is counting on you to act on. If you are a person who has spent a lifetime building something, a retirement account with $100,000 or more inside it, the danger in a moment like this is not that silver is finished. The danger is that a shakeout scares you into abandoning your own protection at the bottom. So let me tell you what a lot of people your age are quietly doing instead of panicking. The largest, most informed buyers on the planet, the central banks, have been accumulating physical gold at a record pace, more than 1,000 tons a year for 3 straight years, roughly double what they bought the decade before. They are not doing that on a hunch. And there is a completely legal, often overlooked way for an ordinary American to do the very same thing inside the retirement account you already have. You can move a portion of that 401k or IRA into physical gold and silver, real metal, without triggering taxes and without early withdrawal penalties, using what is called a self-directed precious metals IRA. This is not some insider trick reserved for the wealthy. If you have $100,000 or more in any retirement account, this is available to you right now. To find out exactly how it works, I have put together a free retirement protection guide. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. It costs you nothing, and it explains the whole process in plain language. Now let me come back to the analysis, because I have only given you half the reason this shakeout is an opportunity and not an ending. The mechanical part explains why the price can fall for no real reason, but there is a second layer, and this one is about the actual metal in the actual world, and it is the layer that ultimately wins. Silver has been running a supply deficit for years. Not 1 year. Several years in a row, the world has used more silver than it has produced, drawing down the above-ground stockpiles that cover the gap. And here is the part that makes silver different from gold in a way that matters enormously. Gold is hoarded. When you buy gold, it mostly sits somewhere, in a vault, in a safe, around the neck, and it stays in the world, recoverable. Silver is burned. A huge and growing share of silver demand is industrial. It goes into solar panels, into electronics, into the countless devices that run modern life. And it goes in tiny amounts, a little smear of it in each unit, dispersed so thinly that recovering it is almost never worth the cost. So it is consumed. It is gone. Gold is hoarded. Silver is burned. And a metal that gets consumed while the world runs short of it year after year has a very different destiny than its price chart suggests during a panic. Think about what that means against the backdrop of a shakeout. The paper price is telling you silver is unwanted, that it should be sold, that the party is over. Meanwhile, in the physical world, the exact opposite is unfolding. The stockpiles are thinning. The industrial demand is relentless, and it does not check the price before it consumes. The deficit does not care what the screen printed this morning. You have a market where the loudest signal, the price, is temporarily disconnected from the deepest reality, the metal. And that disconnection is not a warning. It is the discount. And if you think the 1970s was a one-time fluke, look at how many times this exact pattern has repeated in ways you may have lived through yourself. Over and over, a violent drop in the metal has turned out to be leveraged paper unwinding, rather than the real thing losing its purpose, and holders who mistook the one for the other let go at the worst possible moment. It felt, in the middle of it, like the safe haven story had failed. It had not. Then came a moment where a mere hint, just a hint that the Federal Reserve might slow its bond buying, sent gold down roughly 28% in a single year. Nothing had actually happened. A word had been spoken about the future, and that word alone was enough to shake out everyone who could not tell early from wrong. And there is a chair sitting at the head of that same institution today whose posture has landed more hawkish than markets expected. And that surprise is a big part of why silver was knocked back in the first place. Same machine, same shakeout, same toll booth, every single time. The people who understood that the trial was in the middle, not the end, were the ones still standing when the real move arrived. Here's the part that actually changes things, and almost nobody sits with it long enough. Let me shift gears for a moment. There is a ceiling that has stopped silver twice in modern history. It was turned back near the same level at the start of 1980, and then again more than 3 decades later in the spring of 2011. 2 attempts, roughly 31 years apart, at almost the exact same price. Now think about what sits underneath that ceiling. The base beneath it is something like 45 years long. 4.5 decades of a market coiling under a level it has touched but never decisively broken. Markets that spend that long building a base do not, when they finally go, make small, quiet moves. And there is one more fact about that old high that ought to stop you cold. That 1980 peak, adjusted for what inflation has done to the dollar since, sits far above its nominal number, well into the low three figures in today's money. Silver has never, not once, reclaimed that old high in real terms. Sit with that. The metal is nowhere near its true former peak, in a world running structural deficits, while the biggest buyers on Earth accumulate hand over fist. Now, I want to be honest with you, because honesty is the only thing that separates me from the voices that just want you excited. None of this tells you the bottom is in on any particular day. I cannot promise you a price, and I cannot promise you a date, and anyone who does is lying to you. Silver is volatile. It is one of the most volatile assets you can own, and that volatility cuts both ways. This pullback could deepen before it resolves. The story I am telling you is a case, a strong one, built on real structure and real history. But it is a case, not a guarantee, and nothing I say here is personal financial advice. What I can tell you is that the case does not rest on the daily tick, and the daily tick is precisely what is designed to shake you out. So what do you actually do with that if you own silver or if you are thinking about it? A few principles, not a prescription. First, own the metal, not a paper promise. The entire lesson of the shakeouts is that paper claims are where the games get played, where margins get hiked and positions get squeezed. Real metal in your possession or in a real allocated account cannot be conjured out of existence by a trading desk. Second, and this is the one that saves people, size your position so that no drop can ever force your hand. The holders who get destroyed are almost never destroyed by the market. They are destroyed by being so overextended that a shakeout forces them to sell at the exact bottom. If your position is sized so a 50% swing is uncomfortable but survivable, the shakeout becomes something you can sit through instead of something that ends you. And third, do not sell into the shakeout. That is the whole point of everything I have told you. The middle of the move is designed to look like the end of the move. Let me pull the enemy into the light for a moment, because you deserve to know who benefits from your confusion. When you panic sell into a dip, someone is on the other side of that trade, buying what you are dumping. The trading desks make their money on your churn, on the fear that makes a lifelong holder throw away metal at the bottom. The financial media that amplifies every scary headline is not on your side in this. Fear drives attention, and attention is their product. And nobody in that ecosystem profits from you calmly understanding that early and wrong feel the same. Your steadiness is bad for their business. That is why this understanding is not something you will hear on the channels. You have to come find it. And now we arrive at the part one I have been saving, the part that is the real reason any of this matters to you today. Look at where the informed money already is. The central banks are buying. Gold has already climbed past the euro to become the second largest reserve asset held by central banks in the world, behind only the dollar. The old relationship where gold fell when real interest rates rose has quietly broken because the physical demand overwhelmed the textbook. The smart money already sees what is underneath the surface, but the mainstream, the pension funds, the retail crowd, the financial media, they have not caught up. Silver is still, right now, in that strange window where the story is intact but the crowd has not arrived. You are not late. You are early. And here is the thing about being early that you must understand. By the time it is obvious, by the time silver is leading every news segment and every advisor is finally recommending it, the easy part of the move will already be behind us. The reward is not paid to the person who acts once it is safe and obvious. It is paid to the person who could tell early from wrong and had the stomach to stand there through the shakeout. Nobody sends you an invitation to that moment. There is no bell that rings. The invitation is the discomfort you are feeling right now, and almost everyone throws it away. So let me answer the question the title asks you directly. Silver's biggest opportunity of the year did not open on a green day when everything felt wonderful. It opened in exactly this, the shakeout, the doubt, the pullback that has you wondering if you were wrong. The dip is the opportunity. Being right and being early are indistinguishable while it happens, and that is precisely why the opportunity exists at all, because the confusion clears out almost everyone before the move they were right about ever arrives. If you watched this all the way to the end, you are already different from the crowd, and I want to reward that. I hold a free one-on-one educational web conference for people with $100,000 or more in their retirement savings, and it is genuinely no obligation, no pressure. If you join, just mention that you watched this full video, and let me give you the honest reason to do it now rather than someday. The window where a decision like this is still calm and cheap and fully reversible is exactly the window when nothing feels urgent, when the crowd is looking away, when silver is out of favor and the headlines are grim. That is not a coincidence. That is always what the beginning looks like. By the time it feels urgent to everyone, the calm decision is no longer available to you. To take that step, if you are watching on your television, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguides.com. Come with your questions. Come skeptical. That is exactly the right way to come. Think back one last time to that man in the 1970s, sitting at his table, holding the thing he was right about, while it lost nearly half its worth, feeling every day like a fool. He was not a fool. He was early. The ones who understood that stayed, and the move they were waiting for finally came. The shakeout was never the ending. It was the toll. And the opportunity in silver, the real one, is not going to feel like an opportunity while it is here. It is going to feel exactly like this. That is how you will know you found it before everyone else did.